Good morning. Welcome to the investment meeting of the Teachers Retirement Board, February 3rd, 2022. I'm going to start by calling the roll. Thomas Brown.
Here. Good morning.
Cynthia Collins.
Here.
Allison Hirsch. Here. David Kazansky.
Present.
Deborah Penny. Here. We have a quorum. Turn it over to you, Madam Chair.
Thank you very much, Patricia. Good morning, everyone. First on our agenda, we'll have a market outlook by Robin and Mike from Ropeton. Not that.
Good morning, everyone.
Good morning,
Michael
Mike.
Fulvio. Good morning, Michael. There we go. That's the right one.
Okay, just making sure we have that. Okay, hopefully that's an easy to read visual, excuse me, for everyone to follow along. And Robin, did you want to begin that discussion? I think you're on mute, Robin. Robin, I think you're on mute.
Sorry about that. I had technical difficulties. Sorry about that. Can everyone hear me now?
Yes.
Yes, yes.
Great. So this discussion is really intended to follow up on last month's presentation about capital markets during 2021. And as I mentioned during that discussion, it's interesting to review the data and look back on where we've been in 2021 and prior years. But the real question is, so what? What does this mean going forward? And so we've tried to put together a few thoughts on where we are today and what that might mean in terms of capital markets and asset class, risk and return, and therefore what it might mean for the board as it considers various recommendations with regard to the Teachers Pension Fund and the 403B plan. And that's the context for this discussion. So I'm going to launch in. Please interrupt me with any questions or comments. So the first slide, of course, is focused on inflation uncertainty, and we talked about the dramatic rise in inflation during 2021, and that's continued during the beginning of 2022. And so the real question, there are a couple of questions that this poses for us. One is, do we believe that this level of inflation and rate of change in inflation is going to be persistent over the next several years, or do we think this is more in the nature of a transitory event? And the Fed has stopped using the word transitory. We've largely stopped using the word transitory because it's been more persistent than we expected. But we still are fairly optimistic about the fact that inflation will, certainly these rates of change in inflation, we just saw a 7% increase in CPI printed in January of 2022. But we continue to believe that these dramatic rates of inflationary increases have been really a function of responses to the COVID pandemic, and the significant fiscal stimulus, which led to very significant consumer demand, as well as other factors, including the supply chain problems, are primary causes of the rates of inflation we've been seeing most recently. And we think that many of those causes, most notably the fiscal and monetary stimulus, will be abating as we see Fed rate increases. So nonetheless, we are not seers, and it may be the case that these levels of inflation persist. And so what does that mean for our work as we think about asset allocation and manager selection and strategy selection? And so we've put a few notes here. First, that equities, and we have additional data in this deck about this, equities have historically given investors the best chance of outperforming inflation over the long term. We talk a lot about inflation sensitive assets and asset classes, and we do want to continue focusing on asset classes that may respond well to various inflationary environments. But over time, what we've seen is that asset classes that generate the highest level of returns are the best source of returns in inflationary environments. And that's borne out by most of the historical data. So the pension fund and the 403b plans are heavily invested in equities across the globe. And so, so that's a positive for us. But again, as we talk about various asset classes and their response to higher levels of inflation, we continue to believe that equities are the best source of real return for the portfolios we oversee. We continue to encourage our clients to invest in real assets and in multi-sector credit and TIPS, although the timing of TIPS is a question, and how TIPS will actually perform in a high inflationary environment is also a question. But the portfolios, particularly the pension fund, has significant asset allocation to real assets and to multi-sector credit, particularly in the OFI allocation. So we think that the funds are, in general, reasonably well positioned for higher levels of inflation, although again, we expect these levels of inflation to abate over the coming year. Can we go to the next slide, Mike? This slide talks about talks to the point that I just made about U.S. equity generally performing well in inflationary environments because of their higher returns. So again, in inflationary environments, the goal is to get high rates of real return. And over most of these periods, U.S. equity has been able to do that. Next slide, please.
That's what you wanted.
Was there a question?
The way you asked for it.
Okay, sorry. All right, so this slide talks to the fact that although we encourage our clients to retain their significant allocations to equities, we recognize that valuations are expensive across every major asset class. Interest rates are remain historically low, and asset class equity valuations remain historically high. So we have no, we don't believe that generating returns out of either fixed income or equities will be an easy task over the next few years. And so this slide talks to the fact that in an environment where valuations are so stretched, that security and sector allocation will become increasingly important. And we've mentioned, and here we talk about the importance of being active across a variety of asset classes, and talk about the secular shift toward alternatives persisting, because that's the ultimate exercise of active management. There's no passive alternative in the private market asset classes. The pension fund continues to have a very significant allocation to private markets, and we think that that will serve the fund well over coming years. We have included a couple of slides in the back of this deck about active management, because although there is a very strong argument that active management has a role to play in an environment where security selection will become so important, we think that the board has exercised appropriate levels of skepticism about active management, and it is certainly not been a panacea over the past decade in terms of generating incremental returns, and we can talk about that. But we do think active management has an important role to play in generating returns in this very richly valued environment. We can go to the next slide, Mike. Thanks. So here we're talking about the historically low level of interest rates, and this is not news to anyone listening to this presentation. The consensus is that the Fed will have a number of interest rate hikes during 2022, and the consensus appears to be that that will start in March. We note here that the Fed has signaled 3 25 basis point rate hikes in 2022. That's actually expanded to 4, and perhaps the hike in March could be as much as 50 basis points. Nonetheless, it appears to be highly likely that we'll start to see the Fed hiking rates, the Fed funds rate in 2022. But nonetheless, we're coming off historically low nominal and real yields. Real yields continue to be negative. And so in that environment in which we expect interest rates to rise, the asset classes and investment strategies that seem particularly compelling are noted here: shorter duration fixed income strategies, strategies that are using floating rates. Again, we see a lot of those strategies in your OFI portfolio. Private credit transactions, again, that is captured in your OFI portfolio. And we refer to selected equity strategies that target stocks with earnings growth. Otherwise known as value stocks. And we've seen a resurgence of value versus growth stocks. We saw that in spades this morning with Facebook's price plummeting, now known as Meta. But we think this supports the argument for active management. Again, this will be a difficult environment for many sectors with rates rising, and active managers should have an opportunity to add value through careful security and sector selection. If we could turn to the next slide. So this slide focuses on investing beyond the US equity market. So again, this refers to the historically rich valuations in the US equity market, and that's we've seen enormous returns over the past decade on an average annual basis for the US equity market. And the pension fund continues to, as do the variable funds, continue to be globally diversified, and the board is always focused on looking beyond US equities. But this is probably an opportune time to reinvigorate that focus and consider markets that may be even more attractive than the US equity market at this point in time. We refer here to emerging markets, which look reasonably attractive from a valuation perspective. And again, the board has invested in a significant way in emerging markets, again, both in the passport funds and in the pension fund. Moving forward, we can spend a few minutes on China, but the China here is noted as the world's second largest economy. Some forecasts call for China to overtake the US as the world's largest economy within the next decade. And so that means that special attention probably should be paid to this market. We're seeing institutional investors increasingly think about investing in China as a standalone strategy rather than investing in that market as part of a basket of emerging market countries. China now is above 40% of the MSCI Emerging Markets Index, and probably deserves some specialized attention. So that's a topic that we may want to address over the coming year, whether we want to think about China as a standalone market. Moving forward, this talks about the fact that although it's going to be a difficult environment, there are opportunities to take advantage of trends. We talk about techification on this slide, but I think these trends are being addressed in many ways throughout the portfolios in both your public and private markets. We note here at the bottom of the slide decarbonization, and certainly the board is actively investing in sustainable strategies and trying to take advantage of this trend, which will of course persist for decades, but be a significant driver of change within the capital markets. Moving forward to the next slide. This talks about the sustainability revolution. Again, it drives home the importance of the work the board is doing in terms of thinking about how to mitigate the risk of climate change on the portfolios it oversees, as well as taking advantage of opportunities generated by the sustainability revolution. And we've seen virtually all of the flows into asset management products over the past year have been accounted for by flows into ESG equity strategies. So it's been a significant driver of change within the asset management industry. And we know the board is spending a significant percentage of its time focused on how to implement these kinds of strategies throughout the portfolios. Moving forward, I just want to, if we could go into the active management strategies. This is an interesting chart that has very small numbers, so I apologize for that. But what this does is address the question of active management. And the board members know that we spend a lot of time thinking about how we should implement different asset classes, whether we should do that in active or passive implementation. And I've spent a fair amount of this presentation talking about the opportunities for active management in various asset classes. But active management still remains a very difficult strategy to successfully implement. And I think the board has been very judicious in its selection of active management strategies. Maybe I can point to a couple of numbers here. What this chart does is it takes Morningstar, largely Morningstar data, and looks at mutual funds and how they've performed relative to their benchmarks in a variety of strategies. So for example, if we look at US large cap mutual funds, and let's look at the 5-year set of columns all the way over to the right, we can see that among US large cap mutual funds over the past 5 years, about 60% of the value strategies have outperformed their value benchmark, but less than a quarter of the growth strategies have outperformed their benchmark. Conversely, if we look at US small cap strategies over the past 5 years, we can see that over 3/4 of those strategies have outperformed their benchmark. So the point here is, and there's a lot of data, but the point here is that the selection of active managers continues to be a very difficult exercise, and one that certainly deserves spending a lot of time and careful thought on. And we can't simply assume that active managers will consistently outperform passive strategies because of the difficult environment, but it's an effort that's worth spending a lot of time on. So with that, I'm going to conclude my comments and see if there are any questions or comments on this deck.
Thank you so much, Robin. Does anyone have any questions for Robin about the presentation?
Thank you.
Nope. Okay, I guess not. So thank you again for that. All right, next on the agenda, we have the basket clause resolution. Mike, you're going to speak about it? Okay.
Yes, thank you. So as you know, we all are frustrated with our strategic asset allocation and the constraints placed upon us from the basket clause. Under a new leadership, the controller Lander, he quickly has grasped it, gets it, is putting resources into it, and once again we are working with Albany to try and get some resolution and some basket clause relief. A slight twist to our approach this year is we are offering I'm just going to speak to Albany about all three legislative branches. An option. Same thing that we discussed last year was increasing the threshold on international equities that go into the basket from 10% to 30%. And we did that last year as well. And in addition, we are giving them the alternative of just increasing the basket clause from 25% to 35%. So we've done a fair amount of work to that. The controllers reached out to the governor's office. There's been some contact there, and our attempts are to try and get this in the governor's 30-day amendment to the executive budget. I would defer to Allison on probabilities or where we stand on all this. Albany remains a mystery to me. But we are trying hard, working on it for all the obvious reasons, and some of the things Robin brought up about the valuations in international equities as compared to US. As much as we would like to do that, we are at our threshold. We are at the max basket consumption now, and we purposely are there because that's a scarce resource in our asset allocation, and those are the asset classes that offer best risk reward returns for us. So if we could do that, that would be great, but we're constrained. We would have to get rid of something else in the basket in order to do that. So it is of paramount importance. It does constrain our ability to maximize asset allocation. So we're working hard on your behalf to try and get that changed.
Okay, thank you. Robin and Mike from Rokitana, you did a study or you looked it over for us. Do you want to talk to us a little bit about what you think the advantages are?
Sure. I'm happy to take the lead, Robin, and then certainly contribute. So one of the things we used the asset allocation tools that we have one of the things we did was look at if you did ease the constraints in sort of a naive portfolio construction framework, but also being guided by what we think are the practical constraints for constructing any portfolio, right? What would the portfolio potentially look like without some of the basket constraints as they're written today? So if you ease some of the restrictions, could you create a portfolio that potentially increases return while taking a comparable amount of risk? And so from that standpoint, thinking through, right, portfolio efficiency, is there a way to be a little bit more efficient with how you allocate risk across different asset classes and achieve a slightly higher level of return? And using those tools, we were able to determine that it seems possible to do that. And we think that again, in concert with the comments Mike made and how the resolution is written, I think we were able to prove out to ourselves that easing the restrictions at least provides the board with some flexibility to achieve that objective of creating a more efficient portfolio and being able to benefit from some incremental return, while all else equal maintaining some level of expected risk that's consistent to what you have today.
Okay, thank you. And you think that whether either option, the international from 10 to 30 or just 25 to 35, either one of those would be a help, would ease the restrictions?
Yes.
Okay, great. Thank you. Does anyone have any questions for either Mike Haddad or Mike Fulvio about this? Okay, hearing none. I think, Patricia, we're ready for the resolution.
Okay. So this is a resolution in support of modernizing New York State Retirement and Social Security Law, Section 177. Whereas the permissible titles. Please get to the resolve. Resolved that the board supports an amendment to RSSL Section 177 to increase the permissible basket clause allocation in RSSL Section 177(9), or alternatively, to increase the permissible allocation of foreign equity securities in RSSL 177(8), and agrees to convey said support to the appropriate legislative bodies and executive agencies. And be it further resolved that the chair, or in her absence, the executive director, or in their absence, the deputy executive director, is hereby authorized and directed to issue instructions and take any other action as may be necessary to implement this resolution.
Thank you, Patricia. Do I hear a motion?
So moved.
Thank you, Mr. Brown. Do I hear a second?
Second.
Thank you, Mr. Kazansky. Any discussions before we take a vote? Any questions?
Just one question briefly. The asset allocation, the last time we modified our asset allocation was when? Anybody here know?
March of 20.
March of 20. And we have
There's a couple other things going on at that time, but.
right. Yeah, a few things. Yeah. And so I think we have an understanding that every 3 years we would look at it. So should the basket clause make it through Albany and that whole process, even by the spring, if it's included in the budget, I guess we would then start to have discussions about what the asset allocation would look like going forward. It wouldn't be an automatic, expansion that would necessarily benefit us right away, or would there be some sort of immediate benefit prior to us deciding on a new asset allocation?
No, my advice to you would be, we get relief that we do it, and then when you get the CIO things sorted out, we work with Rokaton to do another strategic asset allocation, because it is a fundamental change to how we could allocate with that relief. And I think it requires a full-blown new asset allocation. And I would also say ASAP, given how beneficial it is to your portfolio.
Great. Thank you.
Right. And Debbie, this is Cindy Collins. I just want to say the mayor's office is in support of this resolution as well. We think it just provides the board and the funds one more tool and takes away, a restriction that hampers our ability to get the returns we need for our members. So we're in full support of it as well.
Does anyone else have anything further for discussion? Okay, then all those in favor, please say aye.
Aye.
Any opposed? Any abstentions? Okay, motion carries in support of the resolution. Thank you. All right, now it's time for Passport Funds December 2021 performance review. Mike Folio, take it away. Unless not.
Great.
listen.
No, I'll take the lead, and then I'll pass it to Devon for a quick update on markets through January. Are folks able to see the Passport Funds report?
Yes.
Great. So I think what I'll do is I'll touch upon December very briefly, and then try to focus a bit more on the calendar year of 2021 in its entirety, because it was a good year. And in that vein, December was also a pretty good month for markets. You can see from some of the numbers in the month column here, was a positive month across the board for equity markets. So the Russell 3000 was up nearly 4%, and non-US markets up a bit over 4%. The diversified equity fund as a whole returned about 3.8% for the month. That was roughly in line, though slightly behind, the global market composite benchmark, which was up right around 4%. And for the full calendar year of 2020, you can see the diversified equity fund was up about 20.24%, the global market composite up about 23%, and the hybrid benchmark up 2.3%. I do want to comment very briefly that the global market composite benchmark, you'll recall that prior to July 1st, that benchmark was entirely the Russell 3000 index. And given the stronger return for the Russell 3 for the full year of about 26%, that's why that number for the first 6 months of the year did not include the international equity markets, which comparatively underperformed the US during 2021. But nonetheless, a strong absolute return of about 20.2% last year. And you can see that's right in line with what we saw from the hybrid benchmark. The only thing that I'll highlight as well, going back to some of the comments about active management, you can see the two remaining portions of the fund, which include active management at the end of 2021. Last year, the active US equity composite returned 22.4% versus its benchmark at 20%. And the international equity composite also outperformed its benchmark to the tune of about 50 basis points. So it was generally a strong year for active management in these two composites last year. And what did detract from performance a bit last year in the quite strong equity market that we saw was the defensive composite, which was a component until right before the end of the year last year. And that would have had really in what was a really strong equity market, didn't fully keep up as I don't think we would have expected in the past from that composite, but nonetheless, active management contributing quite notably to returns in each of those composites during 2021. The balanced fund last year, you can see returned about 5.2%, a bit ahead of its composite benchmark, up about 4.6%. The international equity fund returned 8.4% versus the composite benchmark up 8.3%. And then the sustainable equity fund last year had a strong return, as you can see, up 3.3%, outperforming the Russell 1000 Growth Index, which is its underlying benchmark. That index was up 27.6%. It was a strong year again for large cap growth stocks, which again drives the underlying returns for that benchmark. The U.S. equity index fund last year up 25.8%, and the international equity index fund up 7.9%. So strong absolute returns across the board. And I'll pause there to see if the board has any questions on 2021 or December.
Thank you, Michael. Any questions for Michael? I guess not. So take it away, Devon.
Thank you. On the heels of what Mike was mentioning, after a strong 2021, January has been a rough year for equity markets, led by all the sentiments that Robin had mentioned, including inflation, monetary policy shift, geopolitical tension, and Omicron, all of which have contributed to a sharp increase in the volatility for the month. Not surprisingly, we saw less than stellar performances across the diversified equity fund benchmark. The global market composite was down by 5.46% for the month, and the diversified equity fund was fell by 5.5% for the month as well. However, those results were in line with the respective benchmarks, which also had negative performance due in part to market volatility. Moving over to the balance fund. Though equity was down by over 5% for the month, fixed income performed relatively stronger. That offered some diversification to offset negative equity returns in the balance fund, which had a loss of 2.25% for the month. And the international composite benchmark, one note here, although all the benchmarks were down, on a relative basis, the equity emerging market index was actually performed slightly better than the rest of them. It was only down by 1.89%. So that's on comparison to the developed market benchmark, it actually outperformed. And moving over to sustainable equity fund, January was indeed a tough month for the growth stocks in general, given expectations for the Fed would actually raise interest rate, which will have more of a meaningful impact on the broader equity market as a whole. So as a result, we saw tough performances from Brown Advisory, which resulted in 12.6% for the month, slightly lower than the actual benchmark of 8.58%. And that's it. Any questions?
Okay, any questions for Devon? Yes, not. Thank you so much for that presentation. And just next time, if you can give us a little better news, we would appreciate that. Work on that. Michael did a great job, great news. No pressure. Okay.
That was
Great.
good.
Do we have anything else for public agenda?
That concludes what we had planned for.
Okay, great. Thank you, Michael. Do I hear a motion to move into executive session?
So moved.
Thank you, Mr. Kazansky. Do I hear a second? Second. Oh, thank you, Ms. Hirsch. Any questions? All those in favor, please say aye.
Aye.
Okay. Yep. Any opposed? Any abstentions? All right, we are going into executive session. And just a special note, thank you for TRS. They're working very hard, Liz and Ron and Susan, for breakout rooms. And it's definitely a lot of work and we appreciate it. So just hang on and we'll find out where everyone's going. Session for the investment meeting on February 3rd. Ms. Stang, would you like to report out, please?
Certainly. In executive session at the pension fund, we received a presentation about rebalancing ranges and the market outlook. We received an update on a public equity initiative. We received a presentation for an emerging manager within fixed income. Consensus was reached. We received a presentation in private equity. Consensus was reached. We received a recommendation in real estate. Consensus was reached. In executive session on the passport fund side, we received a recommendation on a manager. Consensus was reached, which will be announced at the appropriate time.
Thank you very much. Do we have anything else for public agenda, public meeting?
I believe so.
Okay, hearing none, then do I hear a motion to adjourn?
So moved.
Thank you. He said reluctantly, Mr. Kazansky, do I hear a second? Second. Thank you. Any
The drum
discussion?
roll, please.
All those in favor?
Aye.
Any opposed? Any abstentions? Okay, we stand adjourned. Thank you, guys.
Thank you.
Take care,
Bye,
everyone.
everybody.